Welcome back to the channel. Today we're diving into the top options trading strategies you need to know for 2025. Whether you're a seasoned trader or just getting started, these strategies will help you navigate the market with confidence. Now, before we jump in, I want to emphasize that options trading can be risky, especially if you're not familiar with how it works. It's crucial to do your own research, understand the potential for losses, and consider your own risk tolerance before making any investment decisions. Remember, this video is for educational purposes only, and it's not financial advice. That being said, options trading can also be incredibly rewarding when done right. By understanding and implementing the right strategies, you can potentially amplify your returns and even protect your portfolio from downside risk. So, let's get started and explore the top options trading strategies that can set you up for success in 2025 and beyond. Before you even think about diving into options trading, you absolutely need to have a solid grasp on market trends. Think of it like this: you wouldn't jump into a car and speed off without knowing where you're going, right? Same goes for trading. Understanding market trends is your roadmap to making informed and strategic trades. First things first, what exactly are we talking about when we say market trends? Basically, it's all about identifying the overall direction the market or a specific asset is heading in. Is it trending upwards, indicating a bull market, or is it heading downwards, signaling a bear market? Knowing this is crucial because it helps you anticipate the potential movement of your options contracts. Now, how do you actually figure out these trends? Well, there are a bunch of tools and techniques you can use. Technical analysis is a popular one where you look at charts, patterns, and indicators to predict future price movements. Then you've got fundamental analysis, which involves digging into a company's financial health, industry trends, and overall economic conditions to assess its potential for growth. Savvy traders use a combination of both technical and fundamental analysis. And remember, market trends aren't just about the big picture. You've got to zoom in and analyze specific sectors and industries too. The takeaway here is simple: don't underestimate the power of understanding market trends. Let's dive into covered calls, a popular options trading strategy. Think of covered calls like being a landlord generating income from an asset you own. You own stocks and sell call options on them. Selling a call option gives someone the right to buy your shares at a set price before a specific date. You receive a premium up front, your income, like collecting rent. This premium offsets potential losses if the stock price drops. If the stock price rises above the strike price, the buyer may exercise their right to buy. You might miss out on some profits but still keep the premium. Covered calls are great for neutral to slightly bullish investors. Generate income and benefit from moderate price increases. Plus, it offers some downside protection. Chapter 3. Protective puts shielding your portfolio from unexpected storms. Imagine this: you've built a solid investment portfolio, carefully chosen stocks that align with your financial goals. But then, bam! An unexpected market downturn hits, and your portfolio takes a hit. Wouldn't it be great to have a safety net? That's where protective puts come in. Think of protective puts as insurance for your portfolio. Just like you insure your car or home, protective puts act as a buffer against potential losses. You're buying a put option on a stock or an index you own. This gives you the right to sell at a predetermined price before a specific date. If the market dips, you can sell at the strike price, limiting losses. It's like having a guaranteed exit strategy. Of course, this insurance comes at a cost, the premium you pay. If the market recovers, you can let the put option expire, only losing the premium. Chapter 4. Iron Condors, soaring high with limited risk. Alright, ready to level up your options trading game? Let's talk about iron condors, a strategy that might sound a bit intimidating at first. But trust me, it's all about managing risk and maximizing profit potential within a defined range. In essence, an iron condor involves simultaneously selling and buying options contracts at different strike prices, all with the same expiration date. You're essentially creating a neutral options strategy that profits when the underlying asset's price stays within a specific range. Here's how it works. You'll sell an out-of-the-money call option and an out-of-the-money put option with a higher strike price. At the same time, you'll buy an even further out-of-the-money call option and an even further out-of-the-money put option to limit your potential losses. The beauty of the iron condor lies in its defined risk and reward profile. You know the maximum profit you can make, it's the net premium you receive when you open the trade. Your maximum loss is also limited. It's the difference between the strike prices of the options you sold and bought, minus the net premium you received. Iron condors are a more advanced options trading strategy, so it's essential to have a solid understanding of options basics before diving in. Chapter 5, Straddles and Strangles, Riding the Waves of Volatility. Get ready to embrace volatility because that's where straddles and strangles, two popular options trading strategies, truly shine. These strategies are all about profiting from significant price movements in either direction, regardless of whether the market goes up or down. Let's start with straddles. This strategy involves buying both a call option and a put option with the same strike price and expiration date. You're essentially betting that the underlying asset's price will move significantly, but you're unsure about the direction. Now imagine the stock price makes a big move. If it goes up, your call option gains value, and if it goes down, your put option increases in value. In either scenario, you stand to profit as long as the price swing is large enough to offset the premium you paid for both options. Strangles are very similar to straddles, with one key difference. Instead of buying call and put options with the same strike price, you buy them with different strike prices, but the same expiration date. The call option will have a higher strike price than the put option. The advantage of using a strangle over a straddle is that it's typically cheaper to implement because you're buying options that are further out of the money. Outro: mastering options for 2025 and beyond. Thanks for watching. If you found this video helpful, make sure to hit the like button and subscribe for more trading tips and strategies. Leave a comment below with your favorite options trading strategy for 2025. See you in the next video. Remember, options trading can be a powerful tool for amplifying your returns, but it's essential to approach it with caution, do your research, and understand the risks involved. Never invest more than you can afford to lose, and consider consulting with a financial advisor if you're unsure about any strategy. The world of options trading is constantly evolving, so stay informed, stay educated, and never stop learning. Thanks again for watching, and I'll see you in the next one.